Hello traders, Gary Wagner here, just about 10:20 in Honolulu, 3:20 in New York. It is Wednesday, February 24th, 2016, and this is the Daily Report for Gold and Silver. We had a phenomenal rally in the precious metals markets, which is really starting to peter out just a little bit. As you can see, we're looking at gold currently trading up about $2-3 on the day. The low is 22, the market's trading at 27, but the key is the high today, 1253. That was the high earlier this morning in gold. It is still trading up, it's trading up solidly, but certainly well off of the highs on the day. Now, silver has been under pressure for the better part of the day, trading at 1521, the low 1518, and the high 1557 on the day. Traders, yes, we are trading higher on the day. Absolutely no doubt about that. Currently trading roughly at 1230 and change, up 770 when you look at COMEX gold. But the real tell of the tape right now is a single candle type that we are looking at. This, of course, is just set at 1440, so it is a daily chart. And the one thing that you can really see is when you look at the range between the open and close, that's this small bodied area right here. It's very, very narrow. And then when you compare that to the range between the current and the high of the day, you get a pretty extreme tail on this candle. This is very much like a shooting star. If you found it, for example, in this particular formation where it came after an extended rally, it would have a lot more depth than it does right now. But there's absolutely no doubt we have seen this market come off of these really, really strong highs. So how do we make sense of this on a technical basis? Of course, we do understand on a fundamental basis, the same thing with the equities markets. It has been trading very, very sensitive against crude oil. And so crude oil, which was lower in the morning, is now up. We saw the same thing happen in equities, where equities were under tremendous pressure, but they have staged quite a recuperation, so to speak, went into positive and then back to negative territory. We'll cover that in detail on trending markets. But I am looking at our current sub count, and I had assumed that we had a solid wave one. Again, the very, very short term chart here, 240 minutes, but a wave one, a wave two, this long extended wave three. A couple of reasons that made a lot of sense is when we take the range itself from the beginning of this rally down at the recent lows of about 1050, you can see those right here, up to here, you got a very, very strong retracement, 61%. Then when we take a look at the actual rise, we had an extension of 2.61% in terms of the market move here and the market move in wave three. So that was real solid within a lot of the models that we had. Then when this market came down, it came down to a 38% retracement, and it was for that reason that I had tentatively labeled this as a wave four and this the beginning of a wave five. That's still quite possible. However, there's an alternative model that I've been looking at over these last couple of days, because one of the things that we talked about last week was that if we simply look at a standard model, benchmark wave one, and say that wave five should equal wave one, well, we could have seen it because you almost have this straight top, almost have an equal top right now. So as I said, that's one possibility. The other possibility, just in terms of a straight model, of course, is that we did get our wave three here, wave one here, wave two here, wave three, and now four is going to be really unfolding as a compression triangle. Now, if that's the case, we've got the completion of wave three here at the top. Then we go into a count of 1, 2, 3, 4, and possibly a fifth wave down here, and then we get our breakout. So this would actually conclude our fifth count of this triangle right here, and then we would start into a wave five, and wave five would probably take us at least to match the highs at around what was it, about 1260 was really the tops that we were looking at, and you can see that right here. So we need to see the market if it's going to consolidate, if it's going to back off a little bit, it's critical on a technical basis that it holds this particular area right in here and then begins to move higher. So traders, we are long. We are long from 17. Market is trading roughly 28 to 30. Even if this market backtracks and trades lower, if in fact this is how this model is going to unfold, or how gold prices are going to unfold, and this model kind of fits that bill, then what we can look for is a very, very shallow dip right here, and then a nice little rally following that. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow on Thursday for another daily update and review. We do have our stop sitting just under 1,200. We just initiated the trade. Any traders that are squeamish at all, go pull profits if you want to. There is the real likelihood, I would say about a 30% probability that we could see this final leg down. Otherwise, we should consolidate here and then move higher. But at least for what we've seen lately, this model seems to explain or kind of channel what we're looking at into a way that we can not only digest it, but more importantly, take advantage of it. We'll talk to you tomorrow. Bye-bye.